Welcome to the Nadex Application and Strategy webinar series presented by Daryl Martin from ApexInvesting.com. Today we're going to talk about the strategy known as the Nadex Box Straddle. And I'm going to give you a quick summary of forex or FX and foreign exchange to help you understand the strategy. And we're going to talk about how to trade a straddle with Nadex spreads. I'm going to go into an example of performing a straddle on the Euro USD Nadex spreads and how to calculate the risk and reward, as well as how to calculate how much movement is needed to profit on a straddle trade. One thing that's important for you to know is, even though I'm going to teach you about the euro dollar, this strategy can be done on major indices, commodities, agriculturals, and forex on markets available with Nadex spreads. So first, let's go into foreign exchange. If you traveled out of the US, then you have no doubt dealt with foreign exchange, or FX or forex. And let's say you go to Europe, and you go to the foreign exchange booth, and you give them $100. And what they do is they give you back, say, 81 euros. And, when you're traveling and, you decide that you're going to use your credit cards, you don't end up using any of your cash. So you go back, and when you leave, you want to change your euros back into dollars. And you still have that same 81 euros in your pocket. So you give them your euros, even though you gave them $100 and they give you 81 euros, now they give you $105 for your 81 euros. What this means is the dollar went up in value in relation to the euro. And you've actually just made money on a forex trade. So on forex trading, if you buy the euro dollar, you're buying or getting euros, and you're selling or giving the USD. You did this because you thought the euro was going to go up in value relative to the US dollar. And you also believe that the US dollar will go down in value relative to the euro. On the other hand, let's say if you sell the euro USD, you're selling or giving euros, and you're buying, you're getting dollars. You do this because you think the euro will go down in value relative to the US dollar, and you believe the US dollar will go up in value. So if you're buying, again, you think the euro is going to go up, the dollar is going to go down. If you're selling, you think the euro is going to go down, and the dollar is going to go up. So now let's talk about euro USD spreads now that we understand the euro dollar. On euro USD spreads, the underlying market is the spot market, or the euro USD. And 1 euro USD spread ticks value is equivalent in value to 1 mini lot, or 10,000 units of a euro USD. Each tick or pip, the last digit it's quoted in, is worth $1 per spread, just like on a mini lot. And if you don't have a spread chart for forex, a tip is that you can actually use the master spread chart. That's the widest spread to see a similar chart to the underlying market. It'll be really close to the underlying market, again, if you don't have another charting platform. It's really important that you do understand that the underlying market is not the forex futures market, meaning it is not the 6E CME Euro USD futures contract. And the reason that's important is because the underlying market is the one you want to be looking at. You want to look at that chart. So either be looking at the master spread, which will be very close to the underlying market, or actually look at an underlying chart such as the euro dollar chart. And on the left side here, you can actually see the euro dollar chart. In the middle, you can see the future euro dollar chart. And you can notice they're really, really similar, very close. But you can also, if you stare at it closely, you can see that there are definitely differences in the values, like in the highs and the lows of the bars. And over on the right side, it's what you call a spread chart, where you actually spread the euro dollar, where you buy the euro dollar minus the future contract. And you can see that they stay pretty much the same, about 2, 4, maybe 6 ticks apart. And they'll be very similar. And that number should stay pretty consistent over the course of a day. It'll change a lot over the course of months, but over the course of a day, it'll stay very, very similar. But the reason that difference is there is because of what's called the carry trade, or the interest on the euro versus the interest on the dollar. And that number is actually going to be built into the futures. It's not built into the euro USD forex. And you don't have to understand all that at all. All you need to understand is look at the euro dollar chart when you're trading the euro dollar spread on Nadex. So if you're going to pick a straddle, you want to know the reasons why you're picking a straddle. All right? You're picking a straddle, the straddle strategy, because you think the market is going to move. You think the euro dollar or whatever other market, oil, natural gas, gold, the S&P 500, you think it's going to move a lot. And so when you think it's going to move a lot, but you have no idea what direction it's going to go, and you really don't care what direction it goes, you just care that it moves a lot. And so that's the whole idea of a straddle. You can make money if the market goes up enough, and you can make money if the market goes down enough. And so let's look at a few rules that you're going to want to take into account whenever you're picking what box spreads to do with your straddle. So you want to do it like around an event, like a news event, or on the market open. So ideally you want to enter like before the European or US market's going to open, or before a major news announcement. That way there's enough volatility, enough movement in the market to allow the underlying to move enough for the spread to have the possibility to actually make a profit. And then you also want to pick one that has an expiration with the exact same time on the spread that you buy and the spread that you sell. And I'll be going into an example of that here in a second. In addition, you want one with enough time to expiration to allow what you think is going to take time for it to move. Maybe you think it's going to take 10 minutes. Maybe you think it's going to take 2 hours. Maybe you think it's going to take 6 hours. So however long you think it's going to take, you definitely want there to be enough time to get the underlying time to move so that way your straddle has a chance to profit. The third thing is the floor and the ceiling. You need to pick 2 spreads that has a floor and a ceiling right at where the underlying price is, okay? So the spread that you're buying should have a floor right at where the underlying price is, and that floor should be the same as the ceiling for the spread that you're selling. And again, both of those being right where the underlying price is. So let's look at a chart on the euro dollar, and right here, what you can see on this chart, I use a Renko chart, and you can see on this chart right here that the euro dollar is trading about 1.2370 at the time that we're going to be entering this spread. All right, that means we want to find a spread where the one that we're going to buy has a floor of 1.2370, and the one we're going to sell has a ceiling of 1.2370. All right, so what we're going to do is we're going to go to the Nadex platform or whatever tool that you use to find your spreads, and we're going to look at it. And we're going to find that we found 2 spreads that expire at 3 o'clock, again, Eastern time. So all times on the Nadex platform are Eastern time. And that gives us about 8 hours for our trade, 7 to 8 hours for our trade. And we found 2 spreads that can go in. We can buy this spread at the floor of 1.2370, and we can sell this spread with a ceiling of 1.2370. So that gives us the same floor and the same ceiling and 8 hours for the market to move enough in our favor. All right, so now that we found our 2 spreads, let's calculate our risk and look at our potential profit on the trade. So to calculate our risk, it's really easy. You can just open up the ticket or use whatever tool you're using, and what you'll notice is that the loss says that the maximum is $11. Why is that the maximum loss? Well, the ceiling on this trade right here is 1.2370, and we're selling it at 1.2359. So that means the most it can lose is up to the ceiling of 1.2370, and we'll still have the trade on, so we can't get knocked out of the trade, but we won't lose more than $11 if it goes up on this spread. Now on this spread, we won't lose more than $11 if it goes down. The reason is because the floor on the trade is 1.2370, and we're buying it at 1.2381, or 11 ticks away. So since every tick's worth $1, we have $11 of risk. And no matter how far it goes down, we can't lose more than 11 bucks. So we know that by combining our 2 spreads together, our straddle, okay, then we can only lose a maximum of $22 if the market just stays flat. So $11 on the buy spread and $11 on the sell spread makes a total risk of $22. And then now to calculate a reward, again, the tickets will do it automatically for you, or there's the tools out there that will do it automatically for you. The maximum reward on either one of the spreads is $239. But remember, we're combining both of them together. So since the maximum reward is $239, because it's a $250 wide spread, and we could lose 11 bucks, so 250 minus 239 equals 11, okay? Then $239 would be the maximum reward minus our total risk from both spreads, being $22. That makes our max profit on the trade. If one of them has maximum loss and the other one makes money, the most money we could make on the trade would be $217. $239 minus $22 of maximum risk. So obviously that's a great risk-reward ratio there. Now, in addition, here's a big tip for you. When one spread is at maximum loss, there is no reason for you to close it, okay? Leave it on. And when you close the other side out, and let's say you close it out for profit, the other one that you haven't closed yet, okay, that's at maximum loss, may come back and actually profit before the trade is complete. This could actually increase your total profit, and it could potentially increase it above the initial maximum reward that you originally calculated. So if we look at the risk-reward graph on this, we can see that we have our $22 risk here, and as it moves up towards the ceiling, then we have our maximum profit on this side. If it moves down towards the floor, we have our maximum profit on this side. So long as it doesn't expire within this range right here, then we'll actually profit on the trade. Essentially what we need is we need the euro dollar to move up the risk amount. So since it's 11 ticks on both sides equally, we need it to move up 22 ticks to be break even, or 22 ticks down to be break even. If we were to draw rectangles on our trading chart, this is what it would look like. You would have your box that you bought right here and your box that you sold right here. And when I was saying earlier, like let's say this moves down and you take profit, leave the long one on. It's at maximum loss, and maybe before the box expires, if it could actually go back up and make money. So it's always good, again, if at maximum loss, don't close the spread because it may go back up, and you don't pay any exchange fees if you're at maximum loss on a spread and it expires out of the money. So now let's say we put our trade on, we buy our box, we sell our box, and then the market moves down. And so as it's moving down, we get a trend line, and then all of a sudden it violates the trend line. We decide to close out our trade. And we close out this side, and what we'll do is we'll just assume, to make it easy, that this box just expired out of the money. Okay? So we left it on, but it expired out of the money, and this is where we closed the short trade out. So now we're going to calculate our profit on the trade, or if, did we have profit? Well, it did move more than 22 ticks because we sold the lower spread at 1.2359, and then we closed it, we bought it back at 1.2315. So we actually made 44 ticks on that trade, on the sell spread itself. And remember, every tick is worth $1. So since we made 44 ticks, or you could call them pips, of profit, we made $44 of profit on the sold spread. Now again, we're assuming that the long spread expired out of the money, so we had a total loss on that of $11. So with a $44 profit on the sold spread and an $11 loss on that bought spread, our total profit on the trade was $33 on a $22 risk, and we had no idea which direction it was going to go. We just figured, hey, it was going to move. All right? That's a 150% return on investment in less than a few hours. So if you did 10 contracts, that would be a $330 reward on a $220 risk. And if this trade would have stayed flat, we would have lost $22 or $220 on our trade. But it didn't stay flat. This trade would have made a total of $330 on 10 spreads, 10 straddles, where we bought the spread and sold the spread. So as you can see, this is a really powerful strategy. You can use it whenever you think the market's going to move a lot because of news coming out, things happening overnight in the European market, an economic report like a Fed funds rates coming out, or unemployment claims. There's a lot of different ways that you can use this strategy, and you can apply it to gold, oil, natural gas, corn, soybeans. You can apply it to the Nikkei. You can apply it to the FTSE, the DAX. You can apply it to the S&P 500 on the US 500 spreads. You can apply it to the small cap 2000 for the Russell. You can apply it to the Nasdaq 100, so the US Tech 100. And you can also apply it to the Dow Jones 30 on the Wall Street 30 spreads. And again, all 8 forex pairs that are available on Nadex, plus every other product that they have. So there's a lot of products that you can apply it on, and just have fun with the strategy. Let us know if you have questions. Make sure to visit us at apexinvesting.com and watch our other videos to find exactly how these box spreads work on Nadex. If you haven't got a Nadex account yet, go to nadex.com. You can sign up today and get a free demo account. It takes about 15 seconds, okay? And you can fund an account with only $100 and actually start trading these spreads right away. Also, visit us at apexinvesting.com to learn more about how to trade Nadex spreads and binaries and see what tools that we use to make it easy to find trading opportunities on Nadex.